we started writing out a bunch of possible decision trees. What if they do this with one variable and something else with something else? And you quickly get tied up into lots of different outcomes. I think what's key here is a few things. We think as a baseline view that they're going to raise interest rates today. The market, as Rick was saying, has that mostly priced in. I think the question really does come down to, inside that room, are they reading the developments in the banking sector as mostly systemic or mostly idiosyncratic? And I suspect, looking at what the composition of that extra borrowing from the Fed was last week, looking at how little there were in sort of draws on swap lines this week, that they're probably going to come to the view it's mostly idiosyncratic and less systemic. And as a result, we have them hiking 25 basis points. But it's a real judgment call for them right now, because I think it's hard. Not enough time has passed for them to have complete conviction on what's going on with banks right now.
Right. That brings us, Subhadra, to where rates go from here. Are we in a paradigm now where even if they hike more, long rates are going to drop?
Absolutely. I think that's the price action you're going to see in the bond market, is that if the Fed does increase the dots and suggest a higher terminal Fed funds rate, they had 5 to 5.25% penciled in for this year. If they keep those dots, it's going to be mostly a front-end event in our view. I think that the back end of the yield curve is going to be much more focused on what happens to the impact of this banking crisis, if you will, on the broader markets. It's going to tighten lending standards. It's going to perhaps push the timing of a recession earlier than what people think. I mean, we had a recession penciled in for early 2024. That timeline might get pushed in earlier. Under those circumstances, I think that the long end of the yield curve is going to struggle to rise meaningfully from here, even if the sentiment improves, and even if, for the most part, as Seth was saying, this turns out to be a very idiosyncratic risk in the banking system.
Barry, let me turn to you. You're forecasting a quarter-point hike, as most people seem to be doing, and a pause. Let me ask you what a pause looks or sounds like.
Hey, Tyler, I think it'll be very data dependent on not just the inflation data, which is paramount, but also financial stability. They'll also focus a lot less on tightening financial conditions. That's very counterproductive right now. And we aren't really talking about it, but I'm going to be watching very closely the shape of the yield curve, which earlier guests talked about the recession risk later in the year, and that's why it tilts down. And also their expectation of long-term rates. At some point, they might change that. That'll affect something called R star, and that's going to affect valuation in a great way. But mostly a data-dependent pause, waiting on, we won't see them again until May 3rd, and then 25 basis points.
Perhaps the thing that stands out most, Barry, in my notes about your position is that you believe that we are in a secular bear market that is going to last through the decade.
Yeah, I mean, channeling Alfred Kahn, some people call this a bear market rally or a bear trap. I don't care if they call it a banana. I'm not going to miss 10, 15, 17% rallies. So since last October, we've been bullish, and we've been calling for the low 4,000s, and that's still our target, between 41 and 43, midpoint 4,200 by April. Now, the issue is, over the course of 10 years, we will have the PE and double the earnings and end up at the same point where we were at the start of 2022, which was around 4,800 S&P 500. And that gets into a lot of complex macro, but we've had flat decades before. We did one from 2000 to 2013, and we've done it in the 60s. So it looks like that kind of a setup to us, and we have to trade the range.
What makes you so sure that we're not going to see a repeat of the 2010s, for instance, Barry, when the economy, depending on how much worse this credit issue gets, the economy does poorly, it needs a lot of Fed support, and basically sort of high-tech, FANG, Bitcoin, all of these things have an incredible decade?
Well, we just had one. It's kind of hard to have back-to-back incredible decades. The thing about it is higher valuation would be required, and I just don't see the room for that kind of parabolic valuation at this point. But there are some people out there who think this is like the summer of '98, where you had some financial problems. The Fed cut. This time they paused. The growth had one more rally in it, and we've been positive on growth since last October. There are only two trades, cyclical versus defensive, and growth versus value. And so there are four quadrants you can be in. And we've been more in the cyclical. the slight overweight in the cyclical growth, which is your big tech and your consumer names.